What if I told you there are stocks paying you 6 to 10% a year just for owning them? Not flipping, not trading, just sitting there. A top analyst at Seeking Alpha just released his 3 favorite dividend stocks, and they're all in the same sector that everyone thinks is dying: real estate. Now, here's the thing. After reading his article, I think he's right about the sector, but I think he also forgot one of the best names in the entire space. So today I'm going to walk you through all 4 in plain English, and by the end of this video, you'll know which ones to put your money into. And if you enjoy long-term investment videos and strategies, subscribe to my channel for at least 5 of those every single week. So why dividends and why now? Real quick, in case you're new to this, a dividend is when a company pays you cash every 3 months just for holding the stock. Some companies pay 1%, some 6, 7, and even up to 10%. Now, normally when a stock pays a really high dividend, that's a red flag because it usually means the company is in trouble and the dividend's about to get cut. Wall Street would call these yield traps. And this is the whole point of today's video, is that you get a window where good companies pay high yields just because the market's scared or distracted by something else. And right now, that's exactly what's happening with real estate stocks. Why? Well, there's 3 reasons. First of all, interest rates are still high, and that makes real estate look unattractive on the surface. So these stocks have sold off. Next is that everyone's piling into tech and AI, Nvidia, Palantir, whatever. And that's shifting money away into the AI and tech industry. But the actual businesses are doing fine. Rents are still being paid, tenants aren't leaving, and the dividends are still flowing. That's the setup. Cheap stocks, high yields, real cash flow. Now let's get into those picks. So brief background on where this information has come from. The analyst is Stephen Kress. He's head of quantitative strategy at Seeking Alpha. He had 30 years on Wall Street and used to run a prop trading desk at Morgan Stanley. His system has a track record of beating the S&P 500 by a wide margin. So when he picks something, it's worth listening to. Now, he used a simple screener that filtered for stocks paying 6% or more with cheap valuations and strong dividend safety scores. With those metrics set, 3 names came out. Pick 1 was Alpine Income Property Trust, stock ticker PINE. The yield is 6.29%, and it's a small company with a valuation of around $339 million. Here's what it does. It owns single buildings, like a standalone Walmart, a standalone Home Depot, and rents them out long-term to those companies. That's it. Walmart and Home Depot pay Pine rent. Pine pays you a dividend, and that's the simple business of it. Why does Kress like it? The stock trades at a 35% discount to similar companies. Their cash flow is going twice as fast as the rest of the sector. The tenants, Walmart and Home Depot, they're not going anywhere. So in plain English, you're getting paid 6.3% to be a silent landlord for Walmart and Home Depot. Pick 2, EPR Properties, stock ticker EPR. The yield is 6.6% and it's mid-sized, about $4.3 billion. This one's a little bit different. EPR owns experience places, movie theaters, amusement parks, ski resorts, top golf locations, the kind of things people go to for fun. Now, this kind of thing used to be considered risky. Remember COVID? Theaters got crushed, but people are back and spending on experiences is up and EPR is collecting the rent. So why does Kress like it? It trades at a 25% discount to similar companies. Their growth grade jumped from C to an A-, and that's huge within 3 months. Their dividend has grown over 56% over the last 5 years versus the sector at 3.5%. And in plain English, you're getting paid 6.6% to own a slice of every movie theater and ski resort that people are flocking back to. Pick 3. RMR Group, stock ticker RMR. Yield 10.37%, the biggest dividend of all 3. Smaller company, about 557 million valuation. The twist on this one: RMR is not a real estate company. It's an asset manager. They get paid management fee by other real estate companies to run their properties. So they don't own the buildings, but they collect fees from the people that do. And this is huge. It means RMR doesn't carry property debt. They just collect cash. Why does Kress like it? Trades at 23% discount to similar companies. Their dividend safety grade is an A. Their balance sheet covers their interest payments 6 times over, way more than their peers. 4-year average yield is 10.14%, and they've been reliable. In plain English, you're getting paid about 10% to own the company that runs a bunch of REITs without taking on any of the property risk. Okay, so those are Kress's 3. And I agree with the thesis on all of them. But there's one he completely skipped. And in my opinion, it might be the cleanest play in the entire real estate sector. Simon Property Group, ticker SPG. SPG owns shopping malls. Now, I know you might think maybe shopping malls are dead. But the real story is there's two kinds of malls in America. There are sad malls, the ones with empty stores, broken fountains, closed shops, and so on. Those are dying and they're going to get replaced by online e-commerce. But we also have the premium malls, the ones with Apple stores, Louis Vuitton, Gucci, restaurants, events, places with people walking around with shopping bags full of stuff. These are not dying, they're thriving. SPG owns the premium ones, almost exclusively, and here's what makes them different. Their occupancy is around 95%. That means 95% of their stores are rented out, whilst the dying mall companies are like 70 to 80%. Their tenant sales per square feet are among the best in the entire industry. So the stores in those malls are making money more than stores in other malls. And it's not just shopping, there's also experiences in those malls. People are going there to eat, hang out, watch movies, play games, and you can't replicate those kind of experiences online. There's a real driver there of foot traffic, and it's not going anywhere soon. SPG also isn't a passive landlord. When a tenant struggles, they step in. They reposition properties that they actively manage. And that's why they keep occupancy high, because they keep bad operators out. The yield right now is around 4.5%, which is lower than Cress's 3 picks, but it's also a much bigger, much safer company. And moreover, the dividend's been growing as it was raised once again last quarter. Okay, so we've got 4 names. Let me tell you how I think about this. If you want pure income, the highest yield, and you can stomach a smaller company, RMR at 10% is really interesting. The fact that they don't own property is a feature, not a bug. They just collect fees. If you want safety in a clean business, Pine at 6.3% is hard to argue with. Walmart isn't going anywhere, neither is Home Depot. And by owning Pine, you're a silent landlord of 2 of those biggest companies in America. If you believe in the experience economy, people going back to movie theaters, ski resorts, parks, then EPR at 6.6% is your play. But if you're asking me where I'd put my money, it's probably an SPG. Here's why. Cress's 3 picks are smaller companies with more risk. Higher yield, sure, but if something goes wrong, they fall harder. SPG is a $50 billion company, and they've paid dividends since 1994. They've just acquired the rest of Taubman to add even more premium malls, and they've got a $5 billion credit line. They're not going anywhere. You give up some yield and you get a fortress. And in a market where everyone's panicking about the next AI bubble, owning the best operator in a sector that everyone thinks is dead with the best operator in it, getting paid dividends to wait whilst everyone else gambles. That's a smart move. So to recap, 4 stocks. Pine, silent landlord for Walmart, 6.3% dividend. EPR, experiences and entertainment, 6.6 dividend. RMR, fee collecting asset manager, 10% dividend. SPG, the king of premium malls, 4.5% dividend. And those are the ones. Let me know which one you would buy. I'd love to hear in the comments. And if you enjoy these kind of video breakdowns and long-term investment strategies, subscribe to my channel for at least 5 every single week.